Hi, everybody. This is David Gully, and here I am with another monetary policy update. This is for May 2022. Please check out all our other videos on Bentley EC 391. So today's agenda will be a quick review of the state of the economy, and we'll talk about two of the Fed's most recent policy changes, raising the federal funds rate and the announcement of the balance sheet drawdown or the reduction. We're going to review how the Fed raises the federal funds rate. We'll also review how the Fed reduces the size of the balance sheet, and we'll talk about how these policy changes are transmitted to the overall economy. So a quick review here. First quarter GDP growth in 2022 came in at a negative 1.5% seasonally adjusted annual rate. This is, of course, not very happy news, but one of the key things to keep in mind here is that most of the decline was driven by lower exports. Exports, thanks to supply chain issues and variation in the economies of our trading partners, have been highly volatile. And if you look at the underlying strength of the domestic economy, that's still pretty solid, as indicated, for example, by the now 3.6% U3, that's the standard unemployment rate that is widely reported in the news, complete with strong job gains, and also an increase in the labor force participation rate. Not dramatically higher, but it's slowly but surely increasing from post-pandemic lows. Wages have been growing fairly rapidly thanks to a very tight labor market, but overall, they have not kept pace with inflation, and so that real wages have actually been declining somewhat. But overall, with an improving COVID situation, again, there's kind of an uptick now, of course, there's been a dramatic improvement in the labor market and the overall economy. So here's a visual of inflation measured by the Consumer Price Index. The blue line is the overall headline figure, and the red line is the core figure, excluding volatile food and energy prices. So this has been running at just over 8% for the last 12 months. As you can see, I've got data going back to the 1950s, and inflation hasn't been this high since the late 70s and early 1980s. And as you can see, it's been increasing dramatically here over the course of the last year or so. However, as we'll talk about, there could be forces that are starting to push inflation downward, at least a little bit. The Fed's preferred measure of inflation is a personal consumption expenditure measure. It's a broader measure of inflation than the CPI. And you can see it's also notably elevated. For example, the headline figure came in at 6.2%. The line there in red, that's the core figure excluding food and energy. That's come in at 4.9% over the last 12 months. Now you can see just on the far right here, each has started to fall just a little bit. We don't want to make too much of these 1 month declines here, but as we'll talk about later, it's possible that at least overall inflation might have peaked. Certainly particular goods and services might still see further price increases, but it's possible that aggregate inflation might be on the downward trend, or at least we can only hope. Looking at a slightly different measure of inflation, this is what's called the trimmed mean personal consumption or expenditure inflation. And what happens is that the highest and the lowest values in terms of goods and services, either increasing in price or decreasing in price, those are removed or trimmed, hence the name. And then inflation is calculated without those relatively high and those relatively low values. And you can see that it is still increasing, but notice the level. In other words, inflation around the center for the typical good and service, or good or service, is only between 3.5% and 4%. In other words, noticeably lower than the overall headline figures from both the Consumer Price Index and the personal consumption expenditure inflation measure. What's also important to keep in mind is that inflation is not driven just by factors such as food and energy prices and things like this. Inflation can also be driven by expected inflation. In other words, if consumers expect inflation to rise, then they'll go out and they'll increase their purchases now to avoid higher prices in the future. And that can, of course, become a self-fulfilling prophecy and drive up actual inflation. And so the New York Fed surveys consumers once a month and asks them about their inflation expectations, and plus a bunch of other stuff. And as you can see here, the blue line is the 1 year ahead expected inflation rate. And the red line is the 3-year expected inflation rate. And as you can see that the 1-year expected inflation rate is noticeably elevated, but still well under the current elevated inflation rate, at least as measured by the CPI. But notice more critically, the 3-year expected inflation rate is well below. It's barely half, for example, of the CPI. And so certainly expected inflation is elevated, but it is not elevated to the extent that current actual inflation is. So perhaps over time, especially on the 3-year, that might help keep actual inflation from increasing even further and perhaps might even bring it down. So let's think about some drivers or some factors that have been impacting inflation. So for example, there's a number of factors that might be working to push inflation downward. So specifically, fiscal policy has been somewhat tighter in the sense that expanded unemployment benefits, PPP payments, and so forth. And consider also, for example, the stimulus checks that were sent directly to households. All those factors have ended, so that relatively speaking, fiscal policies become a little bit tighter. Same with monetary policy. The Fed, as we'll talk about here shortly, has increased the federal funds rate now twice, and is also starting on June 1st, as we'll discuss, starting to reduce the balance sheet. So monetary policy is becoming somewhat tighter, and so both fiscal and monetary policy might work to start pushing inflation downward relatively soon. Likewise, as we've already mentioned, the labor force participation rate is improving, so this should increase the supply of labor and help put downward pressure on wages, which can help prevent the wage price spiral from beginning to develop. There have been also some supply chain improvements. Now, we don't, again, be too dramatic about these, but port delays and things like this have improved somewhat. Likewise, households over the last, let's say, 6 months or so, especially most recently, are starting to shift spending from goods to services. Initially in the pandemic, people started buying a lot of stuff, televisions, things like this, just as an example. And so as a consequence, it was difficult for a supply chain that ramped down quickly at the beginning of the COVID pandemic to ramp up quickly. So there's a lot of inflation in the goods market and not so much inflation in the services market. Services, again, not to exaggerate too much here, are not as impacted by supply chain issues as the market for goods. And so as that behavior switches from purchasing goods toward more services, think hotels, think airlines, and so forth. And again, not to say that those sectors don't have their own issues, but that could put at least some downward pressure on inflation. As I mentioned earlier, nominal wage growth, while very strong, has not kept up for the most part with aggregate overall inflation, so that real wages are falling. And as a consequence, that over time might put some downward pressure on spending. Also, as noted, inflation expectations have not kept pace with actual inflation, so might work to help keep actual inflation down. And then finally, the US dollar has gained substantial value against most other currencies. A higher dollar tends to, other things equal, work to restrain inflation by, for example, helping to keep import prices low. So notice the point here is there's a whole bunch of factors that are working to perhaps start to push inflation downward. But there are factors working to push inflation up. And despite the fact I've got a number of factors working to push inflation down and only two on the side of pushing it up, that doesn't mean the downside factors might necessarily win out. For example, food and energy prices have increased very, very dramatically for a number of reasons, not the least of which is the Russian invasion of Ukraine. And so as energy and especially food prices rise, this might put upward pressure on overall inflation. And then finally, various COVID lockdowns in China have put some pressure on supply chains, put pressure on the availability of imports into the US and other countries. And so that's also working to push up prices. But over time, if those start to ameliorate, that might start to work to push downward inflation. So thinking through this with all of this with the aggregate demand and aggregate supply model, what we can do here is visualize some of the things that have been going on. So again, basic idea here, on the vertical axis, we have the overall price level. On the horizontal axis, we have the level of real GDP. The long-run aggregate supply curve represents the economy's maximum sustainable capacity. Aggregate demand can be thought of as the sum of consumption, investment, government spending, and net exports. And then the short-run supply curve measures how firms respond to changes in the price level and costs and things like this in the short run. So roughly speaking, February 2020, in other words, pre-pandemic, a good case can be made that the economy was operating at least in the ballpark in terms of being at full employment. So we could be at something like point A. Pandemic hits in March and April 2020, and due to a variety of factors there, aggregate demand shifted dramatically to the left, and short-run aggregate supply shifted pretty dramatically to the left also. So this worked to put downward pressure on inflation, which we saw, and worked to put very dramatic downward pressure on real GDP, which we also saw. Since then, however, as the economy has recovered, we've seen a very dramatic increase in aggregate demand. And so we haven't seen, however, a sufficient bounce back in short-run aggregate supply. Now, I'm not going to draw a change in short-run supply simply because it would make the graph more complicated. But the idea, as aggregate demand bounces back from the pandemic lows, that's going to put a lot of upward pressure on inflation. And if you still have a constrained aggregate supply, that's going to contribute to or further exacerbate the increase in prices. And so the idea is we have relatively high demand and relatively constrained supply. So turning to monetary policy, so the Fed's most recent meeting took place on May 3rd and 4th. And so they made two policy changes, which we'll talk about here in just a minute, is when you look at the minutes and when you hear Jerome Powell's post-meeting press conference, he indicated, and the minutes indicated, inflation is way too high and should be brought down expeditiously, and that's using the actual Fed verbiage there. The labor market is, again, in Jerome Powell's words, extremely tight, and that's indicated by growing wages, the high rate of quits, the high rate of job openings per unemployed worker, and measures like that. He indicated that the first quarter decline in real GDP that we mentioned earlier is not a signal of the underlying strength, especially of the domestic economy. And in one interesting thing in the press conference, he was asked, Jerome Powell was, about, well, what about a 3/4 basis point, in other words, 0.75% increase in the federal funds rate? And he said that they are not actively considering it. Now, when when Jerome Powell said this, there was a big positive increase in the stock market. And the idea here is that sometimes it's what the Fed says that matters more than what they actually do. So the minutes and Jerome Powell indicated the underlying economy was very strong. He thinks that there's a good chance, again, using his words, that they can bring inflation down without a recession. I might be a little bit more pessimistic than Chair Powell, but I certainly hope that he is right. And so what the Fed is trying to do is they're trying to sort of take some of the wind out of aggregate demand without pushing it down too far. Because if they can do that, they can restrain inflation without doing too much damage to the underlying economy. And then one final thing, and he mentioned this in his press conference, this is very interesting, is he was asked about, well, how can the Fed demonstrate it has some credibility in terms of its policy actions? And one of the things that he noted is that even in advance of further rate increases, because the Fed has only done 2 of them so far, various interest rates, for example, mortgage rates, 30-year mortgage rates, have increased very notably. One of the things he specifically mentioned was the increase in the 2-year Treasury rate. The 2-year Treasury rate has been shown to be relatively sensitive to near-term expectations of monetary policy changes. And so he argued that, well, in the subsequent 2 years, because financial markets are expecting further rate increases, that this is the reason that the 2-year rate and other short rates have risen. And at the end, we'll talk about some of the perhaps difficulties of interpreting it in this way. And so what we want to do here is take a quick review of how the Fed now actually raises the federal funds rate. And back in the day, in other words, pre-2008, pre-financial crisis, what the Fed would do if it wanted to raise the federal funds rate, it would simply undertake some open market sales of Treasury securities. And when they sold these Treasury securities, that would reduce the supply of reserves in the banking system. And since reserves, or the federal funds rate rather, is the interest rate that banks take to lend reserves, that interest rate would tend to rise because reserves are more scarce. Now what they do is they raise what are called to administered rate. This is the interest on reserve balances. And so this is interest paid to banks when banks deposit funds with the Fed. And so this interest rate is now 0.9%, so up 50 basis points. And then there's the interest rate on the overnight reverse repurchase agreements. Those or that's a financial instrument that's available to non-banks. And so this interest rate was raised to 0.8%. And so now the Fed is paying on deposits to non-banks 0.8%, deposits from banks 0.9%. And effectively what happens is this: the Fed is a really great counterparty to work with. They're very safe to deposit funds with, and they're pretty much guaranteed for all practical purposes to pay, the 0.8% and the 0.9%. And so because the Fed is offering these very safe financial assets that pay 0.8 and 0.9%, other short-term borrowers, think commercial paper, for example. If a company wants to issue commercial paper, they have to compete with the 0.8 and the 0.9%. So in other words, in the aggregate, short-term interest rates tend to increase because the Fed increases these two administered rates. And generally, and this is true even today, despite the fact the Fed is engaged in various QE programs, the Fed still has better control over short-term interest rates than it does long-term interest rates. So let's see a visual here. So this is the market for reserves. So we have the quantity of reserves on the horizontal axis, and then we have the equilibrium federal funds rate on the vertical. And so notice we have a downward sloping portion of the demand for reserves curve. So think, as the federal funds rate as an opportunity cost in the days of old of holding bank reserves. And so all things equal, if the federal funds rate rose, banks would tend to conserve on holding reserves with the Fed, because what they could do is they could lend reserves out to banks and earn the federal funds rate. The supply curve is vertical because the Fed has really good control over what are called non-borrowed reserves. These are reserves that come from, for example, open market operations. And so with open market purchases or sales, they can shift the supply left or right. We'll talk more about that here when we talk about the balance sheet. And then the horizontal portion of the supply reserves curve, that's borrowed reserves, and those come from the discount window. And again, this is an entity that allows banks to borrow directly from the Fed. And so the Fed can either supply reserves through open market operations or supply reserves through bank borrowing. What happened, which again we'll talk about in a little bit more detail, is thanks to the various QE programs, the supply of reserves curve shifted very far to the right. And what this would have done had the Fed not begin paying interest on the ONRP facility, say that fast 3 times, to non-banks, and paying the interest on reserve balances to banks, that would have pushed the federal funds rate to 0 or perhaps even negative. And the Fed is not really interested in pursuing negative interest rates, unlike other central banks. And so these two administered rates represent horizontal portions of the demand for reserves curve. And so really what the Fed did is, by raising the ONRRP rate and the interest on reserve balances rate, is they shifted the two horizontal components upward vertically. And so each interest rate shifted 0.5%, or in other words, 50 basis points. And so again, the idea is the Fed is raising these administered rates So now that other short-term lenders have to compete with the Fed, so in that way, in the aggregate, all short rates tend to move upward in concert with the interest on the ONRP facility and the interest on reserve balances. And so you can see here, this is the daily effective federal funds rate. And so did it work? And so here you can see that at the zero lower bound until March of this year, the federal funds rate was around 0.1%, give or take a little bit. And then here, this is the first 25 basis point increase in March. And then here's the first 50 basis point increase in May. And so you can see now, so the current federal funds rate, the current federal funds rate is about 0.83%, in other words, 83 basis points. And so the Fed's first two policy moves here, post QE4, seem to have worked pretty well in terms of being able to raise the federal funds rate to the desired levels. So let's talk about the balance sheet drawdown. So at the May meeting, the Fed officially announced that they'll be beginning the balance sheet runoff on June 1st. And so they're going to do this in sort of two phases. So at first, they're going to let $30 billion worth of treasuries run off the balance sheet through August. Then beginning of September, they'll increase it to $60 billion per month. So in terms of its mortgage-backed security portfolio, on June 1st, they'll start at reducing it at $17.5 billion to the end of August. And then beginning in September, they'll let it ramp up to $35 billion. So starting in September, once the balance sheet drawdown is running at full speed, it'll tend to decrease at about $95 billion per month. Now, what's interesting here is that Treasury securities have an extremely predictable maturity schedule. So the Fed can, with almost perfect accuracy, predict precisely when various Treasury securities in its portfolio mature. Mortgage-backed securities, however, given their nature, are a little bit less predictable. Mortgage-backed securities are bonds that are backed up by generally home mortgages. They're also commercial mortgage-backed securities, but the Fed has, residential mortgage-backed securities. And so when somebody refinances a mortgage or sells the house and pays off the underlying mortgage, those funds are repatriated to the mortgage-backed security holder. And so as refinancings happen and as home sales happen, some of the face value of mortgage-backed securities are effectively paid back to the Fed, and that increases the rate at which mortgage-backed securities, quote, mature. In other words, there's a return of principal. And so as a consequence, what happens then is that the maturity rates of mortgage-backed securities are not as predictable. So recently, of course, mortgage rates have increased pretty dramatically. The standard 30-year home mortgage now is just a bit over 5%. And so what happens then is that people with these mortgages are therefore much less likely to refinance. And so as a consequence, there's been a reduction of the return of principal to mortgage-backed security holders, including the Fed. So here's a visual of the Fed's balance sheet. And so right here you have Treasury bills. That's what's referred to as traditional Fed holdings. The brown shaded area, these are mostly Treasury notes. And the purple, these are mortgage-backed securities. And so the balance sheet has peaked out just short of $9 trillion. And so what will happen starting June, it'll start to decline. And eventually, once it ramps fully up, it'll decline by about $95 billion per month. So how does the Fed go about actually reducing the size of the balance sheet? And what they've been doing since the end of QE4 is they've been reinvesting any maturing principal from both treasuries and mortgage-backed securities. So if they have $1 million of treasury securities that mature, all they do is take the $1 million in face value and buy new equivalent treasury maturities. Likewise with mortgage-backed securities. As these securities pay back face value, they pay back principal, the Fed uses the proceeds to buy equivalent mortgage-backed securities. So in this way, what they would do is if they kept doing this, that the balance sheet would not decline. So the way the Fed's at least initially going to start allowing the balance sheet to decline is simply reduce or perhaps stop the reinvestment of treasuries and principal of mortgage-backs and treasuries. Now, it's very unlikely that they're going to sell treasuries. They could if they wanted to, and they could also sell mortgage-backed securities. It's unlikely, as I just said, that they're going to do this for treasuries, but the minutes of the May meeting suggest that in order to make sure that they're hitting the $35 billion per month drawdown of mortgage-backed securities, they may end up undertaking some outright sales of some of their mortgage-backed portfolio. And the idea here is that when they stop reinvestment, or of course make outright sales, the balance sheet will start to shrink down. So let's see how that works. So let's suppose that the Fed gets $5,000 principal from a mortgage-backed security, and that a $10,000 treasury security happens to mature. And so when this occurs, they see the decline in the asset, the $5,000 on the mortgage-backed, the $10,000 on the treasury note. So they don't reinvest these. So they get the principal back and they get the treasury security matures. What happens, mortgage-backed security and the treasury deposit generate a decline, an equivalent decline in liability. So just focusing on the treasury note here, the Fed, one of its liabilities are deposits from the US Treasury. And so when that $10,000 treasury note matures, it disappears. And on the liability side, a $10,000 treasury deposit likewise disappears. So the bottom line is that the non-reinvestment of principal acts effectively like an open market sale of securities. And so visually what's happening is this. And so this is a similar graph to what I had up here a few minutes ago. And what I've got here, just for comparison purposes, is pre-financial crisis, pre-2008, the supply curve intersected the demand curve for reserves on the downward sloping portion. Post QE, QE 1, 2, 3, and most recently QE 4, the supply of reserves curves intersects the demand curve on the horizontal portion, in other words, where the administered rates are. So as the balance sheet starts to decline, what will begin to happen is at the rate of $95 billion a month, the supply of reserves will tend to shift back to the left. And so what's happening is it will shift back and get closer and closer to the downward sloping portion of the demand curve. And so this brings us to a question here in terms of, well, when's the Fed's going to stop? In other words, what's the eventual size of the balance sheet? Now, so we're not sure yet, and the Fed has not been very specific. But what they've done is they've given us some good general guidance. So this is from the Federal Reserve itself. So over time, the committee intends to maintain securities holdings in amounts needed to implement monetary policy. These are the key words here: efficiently and effectively to in its ample reserves regime. By the way, by ample reserves, they mean on the horizontal component of the demand curve. So in other words, going back to the previous graph here, under this supply curve, that's what was referred to as scarce reserves. And here, this is what ample reserves look like. In other words, on the horizontal component of the demand for reserves curve. And so the idea here is, well, how do we define, again, I won't read you the rest of this because you can pause it and read it for yourself. We want to define visually, effectively, and efficiently here, okay? And what we can see and figure out is, well, where's the effective and efficient size of the balance sheet? Is we can base that on the various liabilities the Fed has to carry. So this is from a very recent Fed financial statement. And so this is looking at the liability side of its balance sheet. And so right now, let's just go down to the bottom here. So right here, so reserve balances with Federal Reserve Bank. So these are reserve deposits that banks hold with the Fed. So they're about 3.3 trillion. And then you have other, these are all the other liabilities combined. So when you add those up, you get about the 8.9 trillion that we mentioned earlier, because remember, liabilities and assets have to be equal. Yeah, so what we want to do now is think about, well, what are these other $5.6 trillion in liabilities? So one of them, currency in circulation. So there's over $2.2 trillion of currency in circulation. So the balance sheet has to be at least that minimum size to finance or to balance out so that assets equal liabilities. It's also the case, so we have these reverse repurchase agreements. Notice that there are over $2 trillion of those. And so combined, just these two figures alone are over $4.3 trillion of liabilities. So again, that would be, again, another example of the minimum size of the Fed's balance sheet. Another component, and we won't go through all of them, another component is U.S. Treasury general account. So the U.S. government maintains basically a giant checking account. I'm exaggerating here to make a point, a giant checking account with the Fed. So there's another almost, $900 billion. So in other words, all the other liabilities, even if reserves on the Fed's balance sheet went to zero, the aggregate size of the balance sheet would be at a minimum of $5.6 trillion. And so there's not that much room in terms of the Fed allowing its balance sheet to shrink. Because remember, before the pandemic, the Fed's balance sheet, assets and liabilities, total about 800 billion. So the point here is this: we're not going to get anywhere near back to 800 billion. All right, so point here is that the balance sheet is still going to be substantially elevated relative to the pre-pandemic values. And so this is from a recent Federal Reserve Bank of New York report that looked at projections of the balance sheet. And so you can see this is the red line is Treasury securities, the blue line are mortgage-backed securities. And so you can see here and here the run-up of treasuries and agencies, mortgage-backed securities during QE4. And here you can see they're projecting the downward decline in treasuries and mortgage-backed securities. And so this is the shrinking of the balance sheet. But notice that based on the projections here, that the minimum value of the treasury holdings is going to be over $4 trillion, well over 4 trillion. Combine that with around roughly, this is by 2024, 25, we're going to have around $2 trillion of mortgage-backed securities. And so we're still talking a Fed balance sheet of well over 6 trillion. Now notice that the Treasury security holdings start to increase about 2025 into 2026, but that the mortgage-backed security portfolio continues to fall. And this is consistent with the Fed's sort of operating principles around its balance sheet. What they want to try to do is return it to a balance sheet where most of the assets are treasuries and relatively fewer of the assets are mortgage-backed securities. And so the continued decline in mortgage-backed securities is consistent with their general principles. And so what we can do now is we can sort of visualize this a little bit more specifically. So the previous version of this slide I was only trying to get across the point is, okay, the decline of the balance sheet shifts the supply of the reserves curve back to the left. So now what we want to do is think about, well, okay, by how far back does it go? And so what will happen is the Fed will shift it back to maybe something like right there, okay? And so roughly speaking, that vertical, that shift there, that horizontal shift might be in the neighborhood of $2.5 to $3 trillion. Again, give or take, what's a few $100 billion amongst friends, right? And so what the Fed wants to do is they want to make sure that the eventual position of the supply of reserves curve is still on the horizontal component of the demand curve. And so what they're trying to do there is they still want reserves to be what they refer to as ample, but they don't want the supply to go all the way back to where the downward sloping portion starts. And the reason they don't is because there are various factors. For example, changes in treasury deposits, changes in, for example, bank behavior surrounding the demand for reserves. Those non-Fed factors might cause the demand curve to shift to the right, the demand curve to shift to the left. They might cause the supply of reserves to shift left. They might cause the supply of reserves to shift to the right. So because both demand and supply tend to shift a little bit to the left and to the right due to non-Fed factors, the Fed needs to leave itself some maneuvering room, some wiggle room, or in other words, a margin of error. And so that's why it doesn't want the supply to shift all the way back to the vicinity of where the downward sloping portion is. So they want to remain ample reserves on the horizontal portion. And so recall that the Fed wants it to be efficient and it wants it to be effective. I might not be spelling effective right. I think I need two F's. There we go. And so by efficient, we want to have the supply shifting as far as to the left as practical. So the smallest balance sheet possible. And by effective, they mean there's enough wiggle room there. There's enough margin for error so that as random factors shift the supply curve to the left or to the right, or random factors shift the demand for reserves to the left or the right, the intersection of the vertical supply stays on the horizontal portion of the demand curve. So the effective component is building in a margin of error. And so then what we want to do here now is think about a little bit, how does the policy change or changes perhaps impact the economy? And what's important to emphasize here is that a single increase, even a 50 basis point increase, isn't going to have a whole heck of a lot of impact. But critically, the Fed has signaled and indicated that a whole bunch of increases are coming. And we can argue about how many increases might be coming and how quickly they might be coming, but they are coming. That's exactly what the Fed has said. So as we mentioned earlier, even prior to the Fed's announcing its first interest rate increase in March, mortgage rates started to increase pretty dramatically. So when we combine an expected path of higher federal funds rate with the balance sheet drawdown, that's also working to act similar to a higher federal funds rate in terms of slowing the growth of aggregate demand. And so what we've got here is, aside from actual tighter policy, we have the expectation of tighter policy working to slow down the growth in aggregate demand in order to reduce inflation without doing too much damage to the underlying economy. Likewise, the Fed has been very aggressive at telling us that they will do their best to keep inflation under control. And they're doing that to make sure that our inflation expectations do not become unanchored in their verbiage, because if they remain anchored, that helps keep actual inflation down. And the general point here is that expectations matter a lot. And so if the Fed has credibility, and we take the Fed at their word that inflation won't accelerate too dramatically, even beyond its already dramatic acceleration, over time, if life is good and fair, that will help contain actual inflation. But one point we want to make here is Jerome Powell and the Fed have said, gosh, the increases in interest rates are evidence of our credibility. So interest rates have increased by more than the current two policy increases the Fed has recently made. But there could be a number of reasons why we've seen interest rates increase. Like, for example, as we mentioned, mortgage rates. They might be, in fact, because of expected Fed policy actions. Okay, that might happen, but it could also be, because there are expected changes in the real economy, or perhaps more critically, because borrowers are demanding higher interest rates in the face of higher expected inflation. Again, so there could be a number of factors that are driving up interest rates aside from the impact of any expected Fed policy changes. All right, so then summary here, inflation has been quite elevated. Again, that's using Fed verbiage, and it's expected now to remain so for a longer period of time than previously anticipated. Until not very long ago, the Fed was referring to the elevated inflation as transitory. They've backed off on that language for obvious reasons. And so what they're going to do is increase the federal funds rate more quickly and more aggressively than had previously been anticipated. And they're also going to begin the drawdown. And that drawdown of the balance sheet will be faster than the drawdown of the balance sheet that started in 2017 and ended in 2019. We've mentioned Ukraine here a little bit. This situation has introduced, aside from the terrible military consequences, some dramatic economic consequences as well. For example, energy prices have skyrocketed, but then they fell, but now they've increased again pretty dramatically. And so this is going to be, an issue going forward. Likewise, food prices have increased very dramatically, and these perhaps could get even worse. And so low-income people and low-income countries are going to be most negatively impacted by the high energy and by the high food prices. And what we want to emphasize here critically is there's a lot more uncertainty. And given this fact that there's more uncertainty, there's a higher chance the Fed of making policy mistakes, moving, too much, too fast, or perhaps too little, too slowly. So in other words, there's a high chance for a policy mistake. So we hope that there isn't, but unfortunately, there's a good chance. So the idea here is that when you combine the fact that you've got this uncertainty with the idea that policy acts with a lag, it takes policy changes that happen now a while, months perhaps, to impact the underlying real economy, you might get more volatility, not just in the economy, but also financial markets. And then finally, as we mentioned earlier, it's possible, we want to emphasize this word here, may have reached its peak. All right, thank you, everybody. Thank you for listening.